We are now going to talk about the process entrepreneurs follow in order to launch and establish their strategic initiatives. Entrepreneurs, people who start up companies, are key to the ICT industry. Google, Apple, and Microsoft started with humble beginnings, and all were startups created by entrepreneurs. They all developed into large corporations, but they all owe their start to people who were willing to take a chance, who saw potential, and were willing to invest in those companies in the beginning. Hard to imagine now, but Google, Apple, and Microsoft were risky investments. People were willing to make those investments early on, without which none of these companies would ever get off the ground. We would not have Google, Apple, Microsoft, and others like Twitter, Facebook, or Amazon if it were not for the coming together of the entrepreneur with a vision and those who believed in the vision, saw opportunity, and invested in those companies when the safe money would have bet on something else. So we're now going to take a moment to explore how that investment process unfolds. First of all, how entrepreneurs get started, their funding source. Starts out with bootstrap financing, basically the founder's hard-earned investment, their own money, and the effort they put into starting up the company. They may actually secure money from friends and family, the rich uncle or mom and dad. Wozniak and Jobs were legendary for the fact that they started in Steve Jobs' parents' garage in Cupertino, California. The next typical level is an angel investor, some wealthy individual who is looking for good opportunities to invest his or her money. These are individuals that are out on the lookout for great opportunities. They oftentimes get involved in the business. They offer counsel. They're usually putting up their own money, so they want to make sure that it's protected. And they're looking for a pretty high return. They're looking for 10 times return or more. And typically they're looking for a reward when the company goes public or when it gets bought out or through some other means. But again, high risk, so they expect a high reward. Probably most famous and most talked about in the high-tech world is the whole venture capital. Let me just say that entrepreneurs have this mystique about being renegades, answering to no one. This is really only true if they're wealthy enough to fund their own ideas. But in most cases, they have to get others to fund their ideas. And a large amount of the time, it comes from venture capital firms. They go through a process that we're going to describe here. But before we do that, I just want to give you a little background with respect to venture capital firms. They invest in the range of $500,000 to $5 million. Occasionally more than that. Venture capital firms are typically involved in the business. In the world of ICT, they seem to congregate around a place in Menlo Park, California called Sand Hill Road. Two famous venture capital firms, one Kleiner Perkins, Caulfield and Byers, and the other one's Sequoia Capital, are both located there. Let's talk a little bit about Kleiner Perkins first. Kleiner Perkins specialize in investments in the incubation and early stage companies. They've been around since 1972, and they've supported hundreds of entrepreneurs in building over 475 companies, including such major names as Amazon, Sun Microsystem, Electronic Arts, Genentech, Intuit, AOL, Genomic Health, VeriSign, Google. More than 150 of the firm's portfolio companies have gone public. Its teams include the world-leading venture capitalist John Doerr, who actually sits on Google's board, Sun Microsystems co-founder Bill Joy, former Vice President Al Gore, and former U.S. Secretary Colin Powell. I bet those two have some interesting discussions. Sequoia Capital is a large investment venture capital firm. They have offices in U.S., China, India, Israel. They've invested in Apple, Google, YouTube, PayPal, Cisco Systems, Oracle, Electronic Arts, Yahoo, NVIDIA, Navigenics, Atari, LinkedIn, Zappos. So a lot of famous startups. Venture capitalists, unlike angel investors, get pooled funds from a lot of different individuals. Again, these are people that are all looking for a higher than market rate of return. The next level is private placement. These are typically investment banks or agents of certain large groups of funding sources. They typically fund at levels of $5 million or more. They're expensive. They charge an interest rate or a high rate of return, unlike venture capital firms who wait for their payday, some future point where either the company's profitable or cash flow positive, or they actually go public in an initial public offering. Private placement firms look for payment along the way. They have very little tolerance for losses. They seek a high degree of control and been known to bounce out founders from organizations because they haven't been meeting their financial commitments. And then finally, initial public offering. This is where firms go to the public markets, the bond market, the stock market. They often raise billions of dollars. In fact, Level 3, my company, went in their IPO, raised $14 billion to build the nationwide network. And that was a lot. That was a big deal. Spent a lot of time talking with the investment community to assuage any fears, and that was always on our mind. Honestly, Warren Buffett was one of our early investors, so we certainly had his support. It didn't hurt that the company that initiated Level 3 was in Omaha, just like Warren Buffett. In fact, Peter Kiewit and Sons is a construction company, and Warren Buffett has offices in the Peter Kiewit Tower in Omaha. Venture capital firms, what do they look for? Well, first of all, they look for attractive industry segments, high growth potential. They look for a specialty match with their particular area of expertise. Sequoia, for example, and Kleiner Perkins, they specialize in high-tech firms. That's what they go after. Other venture capital firms specialize in different areas like pharmaceuticals or manufacturing. Typically, venture capital firms stay within a fairly close niche. They're very concerned about the management team's expertise, even more so on the idea. They want to make sure that the management team has what it takes to pull it off. They look for consistent management goals and objectives, and that they're rigorously adhered to and reasonable. And they want to make sure that there's a chemistry between the venture capital firm and the management team. They're going to be working closely together, and so they want to make sure that the working relationship will be a good one. Venture capital firms require a return on investment of 500 to 800%, and they require a solid business case verified through their due diligence. And let's talk about what's actually in a business case ever so briefly. First and foremost, they're looking to see if, in fact, the business case answers a key question. And that first key question is there a market opportunity? Does the product or service have a competitive advantage? What unmet need are you fulfilling? Are you a low-cost provider? Are you a product innovator? Are you a value provider? Are you satisfying a basic or performance need? Are those needs actually been identified, and are you in fact able to fulfill those needs? Then it's about customer satisfaction. Do you have those basic and performance and excitement needs covered? What's your unique market position? What distinctive advantage do you bring to the market? And here, again, this is where we talk about excitement needs. What's the level of competition? Are you competing head-to-head with a major force in the industry, or are you going to where others aren't? Are you attacking a specific segment that may be underserved? Do you have access to distribution channels? How are you going to get your product or service to market? Do you have a sales force in place, or are you relying on retailers, third parties, wholesale? What is the way in which you're going to actually get your product to your customers? Sales growth. What do you expect sales to be if you've been in business? What have your sales been? To what extent will you anticipate market adoption? How fast will you go through that market adoption curve that we talked about in week 3? And what is your strategy to capture value? In broad terms, are you a product innovator? Are you a value provider? Are you a low-cost provider? And then what's, from a strategic perspective, what is your specific plan to create, capture, and convert value? Now, the next is, can the firm take advantage of the opportunity? Do you have the financial resources and wherewithal and ability to understand how your business operates? A business case that the venture capitalists are looking for must identify and address key financial, and you need to state the investment level required not only to initiate your product or service, but to sustain an advantage until the product and service can generate enough cash to support itself. And then, How much will you need to be continually invested in this? You've already done both of these. You've established your year zero cost, which is your initial investment level, and then your costs in years 1 through 3 become your ongoing investment level. And then how capital intensive is your business? How much fixed costs are involved, specifically your investment in plant and equipment? And this leads to a concept called operating leverage. Operating leverage is a measure of how revenue growth translates into growth in operating income. Now, it's a measure of leverage, which means how risky or volatile a company's operating income is. Investors look for opportunities where increases in revenue result in disproportionate levels of operating income. Essentially, the lower the break-even point, and you had a chance to calculate that, and you know the formula from that from week 4, the more operating leverage you have. Low fixed costs and low operating costs, of course, are best. But if you have relatively high fixed costs, which is often the trade-off, you better have the low operating or the low variable cost, the low unit costs, to offset that. They'll also want to know how productive your workforce is. How much output can each employee generate, and how many employees do you need in order to get the work done, and how many employees are devoted to overhead. And finally, they need to have confidence in the management team. Can the management team deliver on the promises and assumptions contained in the business case? We'll close this discussion on the entrepreneur's process with just the observation on how critically important the business case is for the startup so that it can actually get the money it needs in order to get off the ground and actually turn its good ideas into reality.